back to the channel. Today I want to break down the latest job report explaining why the market's reacting the way it is, dive into a notable warning signal about December lows, which by the way got broken today, and wrap up this week's performance in the markets. Let's jump right in. Job report highlights. This Friday's job report absolutely smashed expectations. December jobs added 256,000 versus analysts expecting a 150,000 increase. Unemployment rate went down to 4.1 from 4.2% just last month. On the surface, those numbers sound great. A strong labor market means people are working and consumer spending can keep the economy afloat. But there's the twist. If the labor market's doing this well, the Federal Reserve has less reason to cut interest rates. Markets had been holding out hope for a near-term rate cut, but after this strong report, that hope is fading, at least for the immediate future. The Fed's next meeting is on January 29th, and before the report, there was a 93.1% chance they would hold rates steady. Right after the data dropped, that probability jumped to 97.3%. Looking ahead to March 19th meeting, the odds of no cut jumped from 57.7% to 74%. Essentially, the market is now bracing for higher for longer, with the Fed determined to avoid reigniting inflation by cutting rates too soon. But at the same time, is the labor market softening? Even though the headline numbers look strong, other data like the JOLTS report show job openings are trending down from 2022 levels, while layoffs have gradually been on the rise. The big question is whether these measures will stabilize or continue to weaken. Meanwhile, the Fed's own Summary of Economic Projections, SCP, predicts the unemployment rate will stay around 4.3% by the end of this year, which is still historically low. They haven't nailed every projection in the past, but it does signal they expect a reasonably strong labor market going forward. Now let's get to the attached chart above. An important development that happened today, historically, when the S&P 500's first quarter low breaks below the December closing low, it's often a warning sign. The data in the chart shows average full-year return after breaking December lows is negative 0.2%. Median full-year return at 0.1%, and percentage of positive years is only 48.6%. It's almost a coin flip, but the bias slightly leans negative. Today, we did break that December low, so it raises concerns about further downside risk. Of course, historical patterns aren't guarantees, but they can be a useful guide when evaluating market sentiment. Turning to this week's action, S&P 500 fell about 1.94%, NASDAQ 100 slipped roughly 2.19%. A lot of areas are looking oversold. Software, banking, small caps, and even bonds. That might present opportunities for investors who can handle the volatility, but everything hinges on where interest rates go from here. On a year-to-date basis, energy has been the strongest sector. It's essentially in a bear market rally, under its 200-day moving average, acting as a stabilizer in portfolios in these choppy markets, similar to what we saw in 2022. However, the recent run-up might be a chance for existing holders to take profits rather than chase new positions. Well, there you have it. Strong data is paradoxically dragging stocks down because the Fed is likely to keep rates elevated for longer. And to that, the warning sign of breaking December lows, and we've got a market environment ripe for volatility. Thanks for watching, everyone. If you found this recap helpful, please hit that subscribe button and give this video a thumbs up. I appreciate your support, and I'll see you in the next update. Have a wonderful weekend and take care.